Hi there, Etoro. It is Monday the 14th of March, and that means it's time to take a look at what moved the markets last week. It was a rough week for most markets last week for all the reasons that I think we are aware of right now. So the Nasdaq 100 is now in bear market territory. Mid-cap stocks, so as you can see here, the Russell 2000, those are in correction territory, as is the S&P 500. And the FTSE 100 is holding up quite well. So there was quite a strong bounce last week, and this is for a few reasons. One of which, as I said before, is because that particular index is made up of companies like banks, which do well in high interest environments, but also oil majors, and the price of commodities have been, going up quite a lot recently. On Friday, we also got quite a large surprise in terms of GDP growth in the UK. So the month-on-month number was 4 times what was expected. And this is just another surprise on a series of surprises in terms of the strength of the UK economy. Now, the war in Europe is obviously going to have some effect on the UK economy, just like it will have an effect on any European country. But this is pretty damn good news. The most problematic index from last week was the, ETF in this case, is the ETF that is home to some of China's largest technology companies. So this is down over 20% for the week. You can see it's dropped a huge amount just today. Chinese stocks overall didn't have a great week, but you can see that the selling has been focused in a particular area of that economy. Now, there are a few reasons for this. This lady is a pretty good person to follow if you want to learn more about what's going on in China. So some of these I'm going to breeze over, but Chinese ADRs collapsed 10%, and this is from last week, not today, by the way. So an enormous sell-off, the worst since 2008. Strangely, the sell-off seems to have happened on the back of news of a threat of delisting of Chinese ADRs in the US. Once again, this is not the first time it comes up. It came up last year and had quite a big effect, and it comes up once every few years anyway. But I also think that in part it was because JD.com posted earnings, and the earnings were pretty good, but they showed a slow in growth. And that kind of leaked into similar types of companies in the Chinese economy. So I think it was a combination of this news together with the delisting risk that has been freshened in everyone's minds. There are a lot of other things going on in the Chinese economy. So they've set a pretty strong target of growth, even though it's lower than the country has seen historically. It's still pretty strong considering that it is a very large economy. What might have also affected that market is that there was the biggest ever outflows in terms of Chinese government bonds. And as Sophia has said here, one of the theories is that Russia might be redeeming assets in order to build up reserves, potentially in cash, especially now that it's cut off from a lot of the world. Of course, the other thing on the cards is that the coronavirus is spreading in China, so their particular policy when it comes to coronavirus seems to be backfiring. It worked very well initially, but now that the rest of the world has taken a very different approach and is opening up, China seems unable to reopen given the approach that it's taken. And this is going to affect, obviously, the internal economy, but potentially also supply chains around the world, because a lot of countries rely on things from China. That's a hell of a lot of negative news when it comes to China. 2 things to keep an eye on is that credit impulse is rebounding. There does tend to be a lag between credit impulse and the strength of an economy. This indicates that liquidity within the system is beginning to increase, and it might take time for that liquidity to build up, but also start finding a home. So the sentiment within Chinese equities has somehow gotten even worse. It just seems to be deteriorating further and further, but that can only go on for so long. China is an enormous economy. The past few decades of results show that the people in charge know what they're doing when it comes to growth of an economy. There's just a hell of a lot of negative sentiment and a lot of bad things that have happened in a short amount of time. I wanted to do something slightly different today. So most investors lose money when it comes to the stock market. It's very easy to make money when the market is in bull mode and everything is going up and everyone's patting themselves on their back. But when the market turns, that's when things become a bit more trying. Now, I have pulled up this chart before. This is the weekly chart for Alphabet, for Google stock, for the entire time that it's been listed on a stock exchange, for the entire time that it's been tradable. Now, what I wanted to highlight through this is that the stock is incredibly volatile. So you can see that there are multiple periods that are sometimes quite long. Remember, each candle here is a week, where the stock is down in double-digit numbers. Now, it's easy to look back at the meteoric rise of the stock and say, of course I would have invested back in March 2010. But I can guarantee you that the vast majority of people that were on this journey at some point sold out. Think about the pain that you're experiencing in the stock market at the moment. Maybe not in all of your assets, but at least in some of your assets. And if you're someone that invests in high-growth businesses, even quality high-growth businesses, you probably are seeing quite a lot of red at the moment. The point of me throwing this up is to show you that the position that you're in is not unique. It happens fairly often, but that you should detach the movement of a stock price from the performance of that company. The stock price of a high quality business that has demonstrated good, strong growth in a growing industry can be incredibly volatile. It can go much higher than it should in terms of the value of that business, and it can go much lower than it should in terms of the value of that business. And when it's going much higher, that feels fantastic. And when it's very low like this, especially for a protracted period of time, it can be a bit painful. But this is the price that we pay for outsized gains. So I've also included the chart of the S&P 500 for the same period, so since 2004 through to the present day. And you can see that the S&P 500 has made a very good gain through that period. But when you compare it to the gain in Google, you can see that your reward for riding out this volatility would have been quite a lot more than an investment purely in the S&P 500. Now, you might say we're in a unique position at the moment. A lot of bad things have happened in a very short amount of time. A global pandemic, a war, economy is overstimulated. But this is just a subset of the chart that I'm showing on screen. This runs from 2004 to present day. This is 2009 to 2019. Bad stuff happens quite a lot in the world. And it sucks that it happens, but this is just, the way it goes. There were many bad things that have happened before that were unique or quite rare, and they caused the stock market to fall and individual stocks within the stock market to fall quite a lot. But again, if you own good quality businesses that are in good industries, preferably leaders within the industries, eventually the market will turn. I wanted to create a video about different kinds of traders and investors, particularly because on Etoro there are lots of PIs that do things differently. So you get investors, you get traders, and within those categories you get subcategories of each. I think the investor, the famous investor that I identify most closely with is Peter Lynch. So he's quite a funny guy. I don't know if you've read his book. I highly recommend the books that he creates. They've got a lot of good information, but also they're not as dry as some of the books can be. Now, Peter Lynch is famous for a 13-year stint where he increased his assets from $18 million to $14 billion. Now, part of this is because he attracted inflows of money into the fund, but also for this tenure, he achieved an annual return of 29.2%. Now, you might think that this was easy for him. Maybe that was a long bear market and he made a hell of a lot of money and it was easy. Money came easily. But actually, if you go back to that period, it was quite a challenging time to make those kinds of returns. So in 1982, there was an incredibly bad recession, 14% inflation, 20% prime rate. The economy was in free fall. People were panicking everywhere. And his humor kind of comes across in this interview and others. So he goes on to say that, I didn't know that the recession was coming. He jokes a lot of the time that, he can't predict the future and doesn't even try to. So I don't remember anyone predicting 1982 and we're going to have 14% inflation, 12% unemployment, 20% prime rate, the worst recession since the Depression. I don't remember any of that being predicted. It just happened. It was there, it was ugly. And I don't remember anyone telling me about it. So I don't worry about any of that stuff. I've always said, if you spend 30 minutes a year on economics, you've wasted 10 minutes. Now, I think that he probably spent a bit more than 30 minutes a year on macroeconomics. But my point here is that he is a pure bottom-up investor. He found companies that were good quality businesses that were likely to be leaders within the industries, continue growing no matter what. Remember that when economies are going through very difficult times, it is the best companies out of the lot that do the best. His point here is really he doesn't trade macroeconomics. And that's not something that I do really either. I might do it from time to time. For example, if the price of oil goes negative, then I'm almost certainly going to buy some oil futures. But otherwise, there's just too much going on in macroeconomics and it could change in an instant. Whereas a good company is likely to continue to succeed. For example, right now, the price of commodities have gone through the roof, but a number of things could happen that could change that in an instant, and no one can predict these things. So when you are trading macroeconomics, and some people do it very successfully, I personally feel that there's a lot more risk than investing in companies that are strong businesses that are going to do very well in the coming years. And so that tends to be my general approach. All right, what about this week? So we have seen the price of commodities paring back quite a lot, although some of them are still quite high. From 1 month ago, nickel is obviously up quite a lot. I'm not sure if everyone has heard the story about nickel. There was an incredible short squeeze. The price of wheat is still absurdly high. I think that people are starting to shift their supply chains, looking for alternatives to the Ukraine and Russia in terms of commodities, and that means that the prices are starting to come down a little here. Probably the biggest non-war event going on this week is the highly anticipated interest rate decision from the Fed chair out of the US. We are probably going to learn a little bit more about their policy in the coming year. People have analyzed this to death, and there's a range of outcomes that are expected, and I think that have more or less been priced into the market by now. It would take a very large surprise out of this meeting to move the market in any way based on the outcomes. All right, and that's it for this week. I know that it is a very, very trying time in the markets, but it's not easy to be an investor. You've heard over and over again that most people lose money in the markets. And those people aren't losing money in the markets when it's a lovely bull market and everything's going up. It's times like these where people are shaken out of their positions in the market. That's when they lose. So make sure you know what you own, that you've got high conviction, and be patient, because it will turn eventually. All right, thank you very much. Speak to you soon. Goodbye.